Hello and welcome to today's show covering the US jobs report coming on Friday, the 7th of June. By and large, this is coming at a time when there's big question marks around the US economy. Certainly, we saw that weak ISM manufacturing PMI coming out. We also saw deterioration in terms of the GDP number recently out of the US. And by and large, this comes off the back of course, a year, 2 years of strength from the US economy. So there's some significant question marks of, are we starting to see things roll over to an extent? Would that put pressure on the Federal Reserve? Or are we not, quite frankly? And certainly when it comes to the jobs report, we have seen strong jobs numbers for much of this year. And that has really pushed back any idea that the Federal Reserve are under pressure to cut interest rates too swiftly. Well, let's get into the nuts and bolts of it. First and foremost, I want to show you a whole host of different charts to show you exactly where things stand at the moment. Firstly, this is my overview of the jobs market, the sort of main figures that you're going to be looking out for, and a sort of historical perspective, essentially. So you've got the unemployment rate, you can see here, remains low, remains at levels pre-pandemic. The payrolls, we've seen it declining, but it's now back at levels seen as the sort of average area pre-pandemic. Average hourly earnings has been moving towards a downside. That is welcome, but still remains elevated compared to the norm pre-pandemic. And finally, participation rate climbing once again following a recent blip, and moving back to what is perceived to be relatively normal, which is sort of 63 and above percent. First and foremost, I wanted to look at things on the payroll side of things. This has been a key topic because you can see here, whilst we saw a pickup in terms of payrolls over previous months, that has dropped off with that 175 reading last time around. The expectation is that we're going to see a figure below that 200K reading once again on this occasion. And we can see that by and large, a lot of the gains that had been seen previously had been driven, as we see on the top end, by part-time employment over full-time employment. But that full-time area has started to pick up. So that's a sign of positivity. So interestingly, at the time when we're seeing potential concerns around that headline number, we're actually seeing a sort of rebound in terms of full-time jobs, which is where you really want the hiring to be, because part-time jobs we can see essentially counting as doubles, where people are taking on multiple jobs in a bid to address the rise in prices that we have been seeing. In terms of average hourly earnings, we can see here that we have been moving towards the downside. The decline that we're seeing at the moment, 3.9% in that average hourly earnings figure, that's expected to remain steady this time around. And we can see here 0.2, which is the red bar, expected to be replicated once again. So we are actually on a month-on-month basis seeing a drop-off, and you can see that on the 3-month annualized wage growth figure. That decline in the last reading highlights the fact that over the course of the last 3 monthly figures, as we see with the last 3 red bars on the top section, we actually have seen a welcome drop-off in terms of the pace of average hourly earnings growth. And so, as we see here with the core CPI figure as well, the inflation trajectory is a function of the wage trajectory. And we have been seeing that coming off recently, which is a welcome development. So if we do see a figure, the monthly figure of 0.2, once again, I would say that that's a positive for markets. But by and large, it's likely that it's going to be overlooked because, as markets are expecting at the moment, 3.9 is expected to be replicated once again, and in which case you could say, well, wages aren't going anywhere. That's not necessarily true, because when you look at year-on-year figures, they are really dictated by base effects and what's coming out the prior this month last year, essentially, and that's probably driving the year-on-year movements more so than what the current trajectory is. The current trajectory is determined by the last month and the last, say, 3 months, and that's exactly what we're looking at here. You can see 0.2 was the last month, which is a welcome development. And you can see that that is 3-month annualized figure has dropped significantly recently. And we can see here in terms of that drop off in wage growth, that quarterly, which essentially would be like a 3-month reading here on in the purple has essentially confounded that rebound that we saw on the total compensation metric for the quarterly employment cost index. So certainly as things stand, the wage picture is starting to improve and give us grounds for optimism. In terms of the payrolls, we can see here, this is the breakdown for exactly where they're coming from. Last month's figure where we saw a drop down to 175, you can see an almost entire collapse in the government hiring aspect of that report. But arguably the government side of things is the part where, you know, if we saw a massive growth in terms of payrolls, but it was all driven by government hiring, then you wouldn't necessarily feel as emboldened about the strength of the economy. So arguably, if it's going to be something that drops off, it probably makes sense for that to be the government side of things. And interestingly, we saw a sort of collapse in the hiring in the leisure and hospitality segment, which might not necessarily be an awful thing. I mean, look, basically it's services that has been driving inflation of late. And so we do need to see some of the heat taking out the services sector. And also bear in mind, we've seen a pickup in terms of full-time employment, a drop-off in terms of part-time employment, like I alluded to. And so that would primarily be in this kind of area, leisure and hospitality, that you would get people taking on potential for second roles or part-time roles. So that explains why we might see that weakness in terms of that element of the hiring dynamic. In terms of unemployment, I've overlaid a number of different key parts here. Essentially, at the top end, we're looking at the initial jobless claims and the continuing jobless claims. And whilst it's easy to get stuck in the weeds when you're looking at these numbers on a month by month basis and seeing, you know, incremental movements, we haven't seen significant moves towards the upside for these figures. And so I don't necessarily think that they're signaling a big move higher for the unemployment rate, which, as we can see here, look, I've inverted it. So, you know, what we're looking at here is the inversion of it. So it should be moving, it would be moving lower, the black line, if it was going to see an uptick in terms of unemployment. That hasn't happened. Instead, we're seeing it remain pretty steady. You can see the job openings generally will have a correlation between the two. We are seeing that deterioration continue, but by and large, as we can see here, unemployment remains pretty steady as things stand. Here's that breakdown in terms of the wider picture for the what's expected. We can see here 151 expected on that headline number, but keep an eye out for the likes of the part-time versus the full-time roles, because that should really give us great clarity. Like I said, 0.2 on that average hourly earnings figure. Participation rate expected to remain steady as is. But certainly in terms of inflation concerns, we can see here 0.2. If we stay at that level or below, that would make me feel a lot more confident, quite frankly, despite the fact that people would probably get a little bit worked up around that potential flatlining that we'd see if we saw it remain at 3.9%. In terms of the expectations going forward, here's the expectations from the Federal Reserve and market pricing. Currently, this is courtesy of the CME FedWatch site, which is free. So if you want to check this, you can. And essentially, this is the September meeting, which many have been pricing in as the most likely for the first rate cut. Well, that's exactly where we are at the moment. It's around about what looks like 55% chance that we see a rate cut in September. And we can see over the course of the past month, we have been seeing initially a decline in expectations for a rate cut by September, but then that's been gaining ground recently. And like I said, we've seen some data recently that has been a cause for concern. Like I said, the GDP number declining, despite the fact it came higher than expected. We have seen that significantly lower compared to where we were, the 4.9 reading not so long ago. And then we've seen that ISM manufacturing figure coming out. We've got expectations from the markets that we're going to see weaker jobs numbers in terms of payrolls. So we're seeing people growing in confidence around that rate cut in September, and an easing off of those expectations, as we see on the right, around the potential for them to essentially not cut rates in September. Then I want to look towards the back end of the year. So this is the expectations for December. By and large, markets are pricing a second rate cut, but not a third. And we can see less than 20%, which is that 450 to 475 expectation for 3 rate cuts this year. by and large, that is the outlier. And in actual fact, it's between 1 and 2 rate cuts this year. Essentially, you can see it's around about 30% expectation for one rate cut and 40% expectation for 2 rate cuts. And so the question mark here for the sort of jobs data is, first and foremost, are we seeing signs of weakness that would push the Federal Reserve into cutting interest rates to a greater degree over the near term this year? If we see weak jobs data, we're likely to see a growth in terms of the expectation for 2 rate cuts and potentially the outliers, which would be 3 rate cuts, 4 rate cuts, the less likely moves. If we see strong numbers coming out, and in particular, if you see strong payrolls numbers, back up above that 200K mark, then it would set back the idea that we're going to see multiple rate cuts this year and likely lead to a risk off play. Now, the way that these things play out is different each time, but the way that I've seen it play out on the whole is that markets will react first and foremost to just the headline moves. And then maybe down the line, we start to see the intricacies of this data playing out. For example, if we see flatlining average hourly earnings, people will probably be concerned around that. Markets are pricing it in, so its impact wouldn't necessarily be massive. But like I said, if we see 0.2 on the month-on-month figure, then that to me is a reason to be optimistic for a decline in terms of inflation. But instead, we would see people probably focusing in on that headline year-on-year figure. The same kind of thing, if we're seeing payrolls moving towards the upside, people might be fearful that, hey, this strong economy means that we're not going to see too many rate cuts over the near term. Maybe we don't see one in September. Maybe we don't see 2 this year. Well, that would likely be the initial move if that's what happened. But then maybe down the line, give it 5 minutes, all of a sudden everyone starts talking on Twitter and in articles about, oh, this was primarily driven by part-time roles, you're double counting jobs and things like that. You start to see people really rowing back on it. And that's why we see such volatility around this report, because there's a number of different ways that you can twist this data and look at this data. And that means that the initial move is, all the algos that are essentially taking that initial data and saying, hey, payrolls went up, unemployment went down, we're going to react in a certain way. But it's only after a small period of time that we start to see, a lot of the time, those moves unwind. We see a reversal of those initial moves if an underlying story can be told. Recently, that's been around part-time versus full-time job creation. So let me just take you through to some charts. And I just wanted to bring you sort of one outlook from an FX perspective, one outlook from an indices perspective. I'm just going to get rid of my head because that's less important than the charts, as interesting as my head is. So this is euro dollar. So what we're looking at here more recently is a regaining of ground, so a weakening in terms of the US dollar. This is the weekly time frame. So we can see over the course of the past, say, 3 weeks, 2.5 weeks, we've been largely range bound and consolidating, crucially, around this area of trendline resistance, and notably at this 76.4 Fibonacci retracement level, which is at 1089. The bearish trend that has been playing out over the course of, well, essentially since August 23 until now. So coming on towards, it's around about 10 months at the moment. We have been seeing lower highs. The bottom end of it has been a little bit more mixed, as we can see here: higher low, lower low, higher low, lower low. So somewhat mixed, and we're in sort of consolidation mode. But the reliable part of this has been the lower highs, and this is an area where we could see the lower highs coming back into play once again. The daily time frame shows that we did try and break up through that Fibonacci level, but starting to roll over once again. So there's a good chance that what we're seeing at the moment is, as we see here, a sort of pullback period, and then we ultimately see a breakout towards the upside, and then we pull back and then we rally once again, right? So if you look at the near term retracements, you can see, that's a retracement in here. I'm not going to necessarily measure them on this occasion. That's another retracement in there. That's a deep one. And then we're coming into another deep one here. So, there is the grounds for upside if we're looking for some potential US dollar weakness. And what would drive US dollar weakness? Well, it would be a risk on move, a reason for us to be optimistic. And on this occasion, there's a good chance that that could come from potentially weak data, but in particular, weak average hourly earnings data. If we saw a significant decline in the average hourly earnings, then you don't necessarily have the question mark of, why would the dollar weaken when the economy is strengthening? Instead, you would say, okay, great, the inflation side of things is turning. But certainly, if we see markets reacting in a positive light to this data, you're looking for potential further upside for this pair and a potential risk on play, which is a move against the US dollar. However, like I said, if we see strong payrolls in particular, which is a distinct possibility, because if you look at the trend over the past, say, 6 months, we've more often than not been outperforming expectations. You could see an initial pop for this move, and then suddenly people start talking about, well, is it part-time? Is it full-time jobs? You start looking at other parts of the report. But certainly, we've pulled back. We could see a potential pop. We'll look for near-term support down here. Look, ultimately, these levels might break before we actually see the report themselves. But as things stand, we've seen the pullback, then a rally through resistance, and now seeing this sort of higher highs and higher lows. So we need to see a breakthrough 1082 to start pointing towards the bears coming back into play. But certainly, we're at a very interesting crossroads at the moment, because the 76.4 fib has been respected essentially on 4 consecutive weeks. And that's what we're trying to see broken for the time being. And if we do see a breakout, then essentially we need to then break through your essentially 1.1 to negate the bearish trend that's been playing out over the past 10 months. If not, there's a good chance that we do see the possibility of us rolling over once again with the bears coming back into play if we start to see some question marks around that trajectory in terms of US rates and the possibility of just one rate cut, or the possibility that we don't see a rate cut in September. In my mind, and I've broken it down a number of times for you guys in terms of the previews for the core PCE numbers, for the CPI numbers, in my mind, we're not going to see inflation at 2% this year for the US. We're more likely to see inflation moving towards the upside. So the Federal Reserve basically have to make their mind up. Are they going to cut interest rates well ahead of a move to target, or are they going to continue to push back expectations? And if we see expectations push back, then we see likely the US dollar strengthening. This isn't necessarily a Federal Reserve meeting or anything, so we're not going to get commentary from the Fed. But certainly if we saw strong wage data and strong payrolls data, that could lead to another pullback for this market as we see the dollar coming back into play. And then I wanted to show you the Dow. The Dow is an interesting one at the moment, because this has been the big underperformer out of the major markets in the US, because essentially it doesn't have NVIDIA. NVIDIA has been a big outperformer. It's such a heavy weighting for some of these other indexes that we've seen the likes of the NASDAQ and the S&P 500 faring relatively well relative to the Dow, certainly. We've seen this big pullback recently following that tentative new high. We hit the 40K and essentially just sold off every single day since then. Well, we have seen a bit of a rebound coming into play here, so perhaps there's grounds for optimism, and you can see that we're starting to strengthen once again here. So as we see here, the wider trend is certainly a bullish one, and the question mark here is, do we break down through this 37611 to give us a big double top formation? Well, at the moment, the answer is no. That doesn't mean that the answer will be ultimately no. But we can see we've come into this deep retracement at 76.4 fib. We've got this bullish engulfing candle. And so there's a possibility that we see a rebound play coming here for the Dow. You can see here potential higher low, heading higher once again. Certainly if we break up through this 38735 level, then we have the basis of a bottom here for this index set within a wider bullish trend. So essentially taking a bullish retracement set within a long-term bull market. So remaining with the trend, despite the fact that if you look at the short term, it would look like we're not with the trend. But certainly you've got to wait for a signal for that kind of move. And the signal for me would be a move up through 38735. Now, the question mark really is, what about the jobs report? So like I said, ultimately, if we want to see some optimism for this market, primarily we want to see a nice decline in terms of that average hourly earnings figure. But also if we saw a relatively weak payrolls number, it could embolden calls for a second rate cut this year. And even those outlier calls for a third rate cut this year, it would gain greater prominence around the idea that we're going to see a September rate cut. And So therefore, there's a good chance that we see bad news as good news when it comes to the likes of payrolls and unemployment. And the flip side, good news is bad news. What if we see a really strong payrolls number and unemployment rate declining, and we saw an increase in terms of inflation? Well, that would likely drive this market lower as people essentially become fearful that the Fed are going to have to push back on that September rate cut, going to have to push back on the idea that we're going to see 2 or more rate cuts this year. And instead, we just see 1 rate cut right at the back end of this year. So different ways that this could play out. Like I said, remember, what you see in the first reaction for the market isn't always how it's going to end up. A market can be sharply higher, 1 minute after the announcement, and you fast forward 30 minutes and the market could be sharply lower. So be aware of the major volatility. Stop losses are going to be particularly important around this period of time. And yeah, keep an eye out for these numbers, the headline numbers, but also keep an eye out for those underlying factors that I've given you a guide on some of them here. I hope it has been useful. Make sure to check out the rest of the videos on our channel. We're trying to grow it from a relatively small base. So like it, subscribe it. It's much appreciated. And we're going to be continuing to cover a number of these big topics as we move through the weeks.